Good morning and welcome to the Shenkman Private Client Group Accountant Attorney Spring Webinar Series. This program is entitled Estate Planning Nuggets, Creative Planning Strategies for the Rest of the Year. For those of you who don't know me, my name is Jonathan Shenkman. I'm a financial advisor, portfolio manager, and an accredited investment fiduciary at Oppenheimer based in New York City. The goal of all my programs is to bring professionals together to help them better serve their clients. This is done by educating attendees on the latest topics in wealth planning and by encouraging collaboration between a client's attorney, CPA, and financial advisor where appropriate. My practice focuses on working with high net worth families, businesses, and not-for-profits. I manage individual investment portfolios, trust accounts, corporate retirement plans, and endowments to help my clients achieve their financial goals. In addition to the 20 to 25 events I run every year, I also do a fair amount of writing on the topics of investing and financial planning. You can read my work in Barron's, CNBC, Forbes, Kiplinger, the Wall Street Journal, the CPA Journal, Trust and Estates Magazine, and many other periodicals. My latest article was published in Kiplinger and is entitled, What to Do with a Windfall with Markets at All-Time Highs. After the program, I'll send out a link to this article and all the publications where I publish my work. Before I introduce the speakers, an important administrative note. If you are a New York or New Jersey licensed attorney or CPA and will be taking this course for credit, please pay close attention. I will be giving two codes during this program that you must write down to ensure you get credit. The first code is A23. Again, A as in apple, 23. One more time, A23. I will give the last code and further instructions at the end of this program. Today, we're privileged to hear from Jonathan Blattmachr and Martin Shenkman. Jonathan is Director of Estate Planning of Peak Trust, Director of Pioneer Wealth Partners, Principal of Interactive Legal Services, and a retired member of the New York law firm Milbank Tweed. He served as an adjunct professor of law at NYU School of Law and as a lecturer in law at the Columbia University School of Law. Jonathan is the author of 9 books and over 500 articles on tax and estate planning matters. He has been awarded Lifetime Achievement Awards by both the National Association of Estate Planners and Counsels and the Orange County Society of Trust and Estates Practitioners. Jonathan also served as an officer in the United States Army from 1970 to 1972 and was awarded the Army Commendation Medal. Thank you for your service. Martin Shenkman is an attorney in private practice where he concentrates on estate and tax planning. A widely quoted expert on tax matters and thought leader, he's a regular source of numerous financial and business publications and is the author of 45 books and more than 1,500 articles. Martin was named both Worth Magazine as one of the top 100 attorneys and by CPA Magazine as one of the top IRS tax practitioners. He's active in many charitable causes, including the founding of chronicillnessplanning.org, which educates professional advisors on planning for clients with chronic illness and disabilities. Today, Martin and Jonathan will be speaking on estate planning nuggets, creative planning strategies for the rest of the year. And with that introduction, I will now turn the program over to the presenters.
Thank you, Jonathan. We're going to try to tackle very quickly some of the topics that were advertised, but we're going to devote most of our hour to talking about really recent developments and, most important, what do you do as practitioners now? What do you advise clients? The flurry of legislation in Washington and the incredible wide-ranging impact of that legislation has got to be foremost in mind. So I'm going to just take a couple minutes before we jump into the main topic and just talk about a few of the points. Keep in mind that when this program was designed, we had no idea there would be a Sanders bill, a von Hollen bill, or where we would possibly be. We didn't even know the results of the Georgia runoff election. So let me just cover a couple of quick points and topics. One of the things that has come from COVID is rethinking many of the core estate planning, foundation estate planning documents that are commonly used by everybody, not just by your clients, but by all of us. You need to review living wills and healthcare proxies and be certain that the documents don't prohibit intubation. Many standard forms and even language in some attorney-provided forms have blanket prohibitions against intubation. As you all know, with COVID, intubation may be essential to save somebody's life. A blanket prohibition against intubation could be a death sentence. Experimental medical treatments is not addressed in many, probably in most healthcare related documents as part of an estate plan. Yet all the treatments that we have, including the Pfizer vaccine that I was thrilled to be able to finally get a few short weeks ago, are all experimental. So you may want to have clients at least consider expressly authorizing experimental treatments. Finally, we've become electronic. The COVID has launched and pushed even the most recalcitrant of us into handling things online. Our Zoom meeting, as opposed to the in-person meetings that this used to be. So maybe reconsider what provisions you have in healthcare proxies and powers of attorney and other documents to permit agents to sorry, let me get rid of that. Sorry about that. To permit agents to make decisions virtually. 2020 was a flurry of planning, a tidal wave of planning. I felt during the end of 2020 that 2020 actually eclipsed 2012. And as many of you might remember, 2012, we had anticipated the exemption dropping from 5 million to 1 million. And there was an incredible rush of activity at the end of 2012. I found 2020 even more challenging. And part of the issue with 2020, it wasn't just the potential for reduction of exemption that people feared, and we're going to spend most of our time talking about, but the elimination of GST benefits in a wide range, grantor trust, et cetera, that we're going to talk about. So 2021 may turn out to even eclipse 2020, which is hard to imagine, and I can't even anticipate how difficult it may be as the year marches on and more clients start to panic about what the election results and the consequences of the proposals in Washington mean. Just very quickly, though, we need to all still go back and take a look at 2020 planning work and see what needs to be done to shore it up. One of the things that we have found very helpful is we create a checklist or compilation of all the documents on any significant estate plan. And given the mad rush to complete planning before the end of 2020, and as you'll learn, that was a smart move by those clients that did it, preparing a checklist of all the documentation in the plan will help you identify documents that may not have been signed or completed or things that remain to be done. So very important step. Gift tax returns need to adequately disclose all 2020 transactions. One of the things to be mindful of, the accountants preparing the returns often don't have the documentation or even the knowledge of the transactions that the attorneys do. So collaboration is essential. If you prepare the compilation as the attorney that did the planning and provide that with all the backup documents to the accountant, that compilation or checklist can serve as the exhibit list with modification for the gift tax return. Be very careful that if you use valuation adjustment mechanisms, as is commonly done, that all the client records reflect that. So if a client sold to a trust $10 million of equity in an LLC, and it's a Wandry adjustment clause, you need to be certain that the partnership tax return for that LLC reflects in an attached statement that the percentage membership interest is merely an estimate, will be adjusted based on the valuation adjustment clause. We need to make sure we have consistency throughout all tax reporting, because if we don't respect the valuation adjustment mechanisms, it may be more difficult to expect a court to do so as well.
Marty, let me add one word here. If you have transferred the interest to a grantor trust or another disregarded entity, then you're not going to have a problem in allocating the income, because it's all going to go to the client. And that's another reason why, as long as they last, and we're going to get into why they may not last, grantor trust can be the cat's meow in planning.
And we're going to come to that real quick. Gift tax returns. Let me just tell you something I do, and I've done it for a lot of decades, and I still do it. Gift tax returns are seductively simple. And the issue with gift tax returns, it's very easy to overlook some of the many nuances. What I do when I think I've finished reviewing a gift tax return is I get the instructions for the 709 for that year. And I always convert them to words so it's easier to keyword search and things like that. And I spend 15, 20 minutes and I eyeball the instructions when I've just finished reviewing a return so that I can try to identify things that may be missing that I didn't think of. There's a lot of information in the instructions that the IRS wants. And by the way, the instructions are sometimes more expansive than even the regulations. And I think you want to err on the side of over-disclosure and making sure you address anything the IRS wants. Be sure to consider carefully GST allocations. We all often see issues, errors in GST allocations. Is a trust a GST trust? Is it not a GST trust? Make protective allocations in all cases. The middle bullet point on slide 8, I find that it's often overlooked as well. Clients may make transfers, and we saw a lot of this in 2020, to a multitude of different trusts, and may make GST allocations to different trusts. Well, if it turns out that there's a valuation adjustment, which GST allocation should take priority? Trust 1, Trust 2, Trust 3, et cetera. You need to provide a tiering or prioritization, because otherwise I'm not sure how that gets handled. Non-gift transactions, there's probably almost as many different opinions on this as there are practitioners, but my preference generally, but not all the time, is to report all non-gift transactions so we can toll the statute of limitations. Be certain to go over that carefully with the client so the client understands the pros and cons and makes their own decision. And the final point, which is again another commonly overlooked item, be sure to report all charitable gifts. It's often missed, and depending on the nature of the structure of the transactions, not reporting charitable gifts may even prevent tolling the statute of limitations, because it could be a significant understatement of gifts made. Now let's jump, and I wanted to do the last. I know I went quickly, but I wanted to make sure we covered a lot of topics. And please understand again that when we prepared the list of topics we were going to cover, this was last year, we had no idea when this was advertised what the world would look like. So we may have talked the entire time about just 2020 planning, because there may have been nothing to talk about for 2021 planning. Well, the opposite is true. There's endless amounts to talk about right now with 2021. Jonathan, do you want to give an introduction about where we are and what's going on? Or do you want me to jump straight to the Sanders bill, and then we'll do the Von Halen?
Well, Marty, you know, you've kind of set this up already. I mean, we didn't know what the outcome of the election was going to be when we scheduled this program, and now we know that the Democrats control the House and the Senate for certain matters, at least, because if you have a 50-50 tie, which we now have in the Senate, and Kamala Harris, the vice president, can cast the deciding vote. So the Democrats are in control. However, let me talk about the Sanders bill. But since we planned the program, a couple of things have happened. Bernie Sanders has introduced a new bill, which is now called for the 99.5% Act. That means it's only supposed to affect 0.5%. And one of the things that the bill would do, and there's been a proposal for this going back many, many years, is the base rate would no longer be 40% for federal gift, estate, and generation skipping transfer tax purposes, but it would increase to 45, and then it would increase to 50, and then 55. And if you are like Marty and Jonathan and you're a billionaire, well, then you're potentially going to face a 65% rate. And that's federal only. And remember, in addition to that, you may have to pay a state estate tax, which if you're in New York, your base rate will now be about 54% rather than 45%. And if you're in Connecticut, it's going to be the same. New Jersey has repealed its estate tax, at least temporarily, but there are about a dozen states that have one, and you have to watch out for that. And by the way, even if you're in a state like Pennsylvania, which doesn't have an estate tax, it does have an inheritance tax, which if you're giving it to non-family members can be at a very, very high rate. New York also has a proposal, although it has not been part of the budget bill yet in New York, which would vastly increase the gifts on inheritances. The Sanders bill also would reduce the current 11.7 million gift, estate, and generation skipping transfer tax exemption.
Jonathan, you froze. I don't know if everyone else can hear you.
Down to 3.5. I can see you and I can hear you. You can't hear me, Marty?
No, I can. You froze for
okay. I'm sorry, friends. One of the other things that the Sanders bill would do is it would eliminate lack of control and minority discounts for non-active business entities. So, you know, if you form form a family partnership, whether it's an LLC or a partnership, you will not get a discount if the family has 50% or more in vote or value. So the concept of using a family partnership is not going to be the same as it was before. They're also going to, if you have an active business, you will use normal valuation principles, except to the extent that the business holds non-business assets. So if you have a car dealership and you've accumulated a couple of $1 million in cash and you can't establish that that cash is necessary for purposes of operating the business, and that will become an art for people who have active businesses and making sure that what they have and they claim to be necessary working capital, or they're going to expand, that's going to be something that a lot of people will get involved with. But what they're going to do is say, take those non-business assets out, value them without discounts, leave the other assets in and value each separately and add them together. GRATs are going to be significantly hit by the Sanders bill because it would require a minimum term of 10 years for a GRAT, no longer 2-year, 3-year, 4-year GRATs, which most people do, although I prefer to use a formula requiring whatever the minimum is to have a valid GRAT. Second, they would also say that the maximum term you can have for a GRAT is the grantor's life expectancy plus 10 years. And maybe Marty will have time to go in and talk about very long-term GRATs.
There's slides at the end, folks, about that in case we don't.
Right. But the biggest change with GRATs is that it would require that the value of the taxable remainder has to be at least 25%. Now, this is a current thing to worry about a little bit. If you miss the 25%, it means you have an invalid GRAT. It doesn't mean, well, they're going to say that 25% is taxable. So if you put 10 million in the GRAT and you wind up, because you have hard to value assets or something, that the value of the remainder is only 2 million, only 20% of the value of the assets you put in, you don't have a valid GRAT, which means the entire amount put in is going to be subject to a gift tax. Now that means there's going to be a premium on putting down how you determine the value of the remainder. You're going to have basically a savings clause to say that the value of the remainder must be 25%. It cannot be less. So you're going to have to do something about that. As some of you know, I write a program which Marty and other practitioners use called wealth transfer planning, where we have such a type of formula in it. Another thing the Sanders bill would do would be to limit the time that a new generation skipping trust where you want to allocate GST exemption is going to be limited to 50 years. And again, it's not that they're going to say you're now going to be deemed to have it for 50 years. If you don't make it terminate within 50 years, you have a bad trust, so you can't allocate GST exemption to it. Again, formulas will have to be used to avoid that problem. Really an important thing. Probably the biggest change, at least to me, under the Sanders bill, is that grantor trusts, the income of which is attributed to the grantor as though the trust did not exist. Grantor trust would be includable in the gross estate of the grantor when she dies, or if grantor trust is turned off during the grantor's lifetime, it would be considered a gift by the grantor. Or if you make a distribution to someone other than the grantor from that trust before the grantor dies, you're going to have the grantor be deemed to make a gift. I mean, this is an extraordinary thing. Good news is that grantor trust created before the date of enactment, not the effective date of the bill, which will probably be this next January. That's when the exemption will drop. That's when the rates will increase. That's going to be 1/1/22. But for grantor trust, if you create a grantor trust after the date of enactment, let's say that's October 1st, that means that when the grantor dies, the trust will be includable in the grantor's estate. One of the most important things I think that Marty and I can recommend to you is you ought to have your own grantor trust created now. And you ought to urge your clients, your friends, even your mother-in-law to create grantor trust now, even if they are of modest amounts. Absolutely important. Annual exclusions for transfers to trust. And of course, we traditionally use when we make a transfer to a trust and wanted to qualify for the gift tax annual exclusion, we make it a crummy trust. giving each beneficiary a power to withdraw an amount equal to the annual exclusion. And there are various ways to do that. I don't know, I just got a message. Marty, can you see what that message is? Are people having trouble hearing me?
Everybody can hear you fine.
Okay, fine.
Yeah.
Well, in any event, annual exclusion would remain. There are a lot of rumors that it won't remain, and it will continue, as far as I can read in the Sanders bill, to be inflation adjusted. Remember, we started with 10,000. It's now up to 15,000. It's going to continue to be adjusted. But for transfers to a trust, you can only have $30,000. And that's going to be a potential problem for many life insurance trusts. So if you have a client who has been paying or anticipates paying more than $30,000 a year in premiums for the insurance that's inside the trust, if you pay any more, you're now either going to have to pay gift tax or use the lifetime exemption. By the way, use of the lifetime exemption will be automatic unless it's used, but you don't have a chance to do otherwise. Now, many of you have clients who pay more than $30,000 a year in premiums. I got another message. Does farming qualify as a business? There are special rules for farming. They're expanding 2032A. Farming will be an active business if it's really an active business as opposed to a hobby. But let me go back to the annual exclusion. If you're married and your spouse can gift tax, even if the ILIT is for your spouse and descendants, if you have crummy powers in there with respect to the gifts made to your descendants, it means that you can go ahead and have your spouse gift split with respect to the gifts to the people who are not your spouse. So you could do $60,000 a year. So that's what you can do and you'd be okay. But if you're paying more than $60,000 a year, you've got to consider either using part of your lifetime exemption and pre-fund the trust, or to pay more in premiums. Maybe you have a prepaid policy all paid up. That would be something that you really need to consider advising your clients to do. I really suggest you do that. There's also a provision, and Marty, I'm going to ask you, why is this in the bill? The Sanders bill says that you do not get a step up in basis for assets in a grantor trust when the grantor dies, if those assets are not includable in the gross estate. Now remember, I just said a few minutes ago, grantor trusts will be includable in the estate of the grantor, except for ones created before the date of enactment. So if you have a client who has a grantor trust today, but you've structured it so it won't be in her estate, when she dies, this bill says you don't get a stepped up basis. Marty, why is that in there? Does anybody believe you get a stepped up basis on assets in a grantor trust when the assets aren't includable in the gross estate? Isn't that ridiculous, Marty?
It's certainly a tad aggressive according to some, but there have been some wild and woolly practitioners such as yourself who push the envelope writing articles suggesting that that may in fact be the case. And there's certainly practitioners I know that have taken the position under current law that if you die if you die and you had funded a grantor trust, even though the assets are not in your estate, they've argued for a step up in basis and claimed it. And I actually asked a practitioner I know that has taken that position. He says he's done it successfully many times and it's never been audited.
Let me give you the background on this. My dear friend Mitchell Gans, who's a tax professor at NYU for the Masters in Tax program and also at Hofstra Law School, and I wrote an article with one of our colleagues at the time, Hugh Jacobson, about what happens to the assets in a grantor trust when the grantor dies. There were some who said there'd be gain recognition, and we put down 7 reasons, including 2 Supreme Court decisions why they couldn't happen. But we also turned to what is the basis of those assets in the grantor trust when they're not includable in the grantor's estate. And we concluded that they would be entitled to a stepped up basis. Now you say, how can that be? Well, I'm going to refer you to the law. Section 1014A, which provides for the automatic change in basis, starts off by saying that assets acquired from a decedent upon the decedent's death have a basis equal to their fair market value on their date of death. That's what it says. Well, how come when I die does that happen? Well, you know, the official position of the Internal Revenue Service for decades, take a look at Revenue Ruling 85-13, and even more important, take a look at Example 5 in Reg 1.1001-2, paren, little c, close paren. That states that the assets in a grantor trust for income tax purposes are still owned by the grantor. So up until the time I die, I own those assets. Once I die, grantor trust status ends, of course, and that means that whoever succeeds to the asset at that time, that trust, which previously didn't even exist because it was a grantor trust, or the beneficiaries who receive it upon the grantor's death, pursuant to the terms of the trust, they are receiving it from the decedent for the first time for income tax purposes. So it fits exactly under that. Two other things. In 2009, the IRS came out with a chief counsel's advisory opinion saying, no, 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 if it's not on the estate, no step up, even if it's a grantor trust. It was just a statement. There was no reasoning. It was just a statement. Then in 2012, the IRS issued a private letter ruling which said, oh, those assets do get a stepped up basis, even though they're not includable in the gross estate of the decedent. And now we have Bernie's bill saying that assets in a grantor trust don't get the step up in basis under Section 1014 when the grantor dies, unless they're includable in the grantor's estate. Why do they need that bill? Because apparently the people who wrote that bill thought there was real credence to the fact that if you have assets inside a grantor trust and the grantor dies, the basis will be determined under Section 1014, just like it says, because for the first time for income tax purposes, they will be acquired from the decedent upon the decedent's death. So you might want to even consider going back based on this bill where you've had grantor trust end and the client has not taken the position that there was an automatic change in basis to consider that. Maybe you want to go the extra mile and say, well, we're going to make a special disclosure to make sure we can't be fined, although I don't think that's necessary. If you are ultra conservative, maybe you'll do it. But it certainly seems that you can take that position, and I have, Marty, myself, in addition to your other friend, have taken it many times. I've never been challenged. Of course, the IRS rarely asks for documentation of basis, but that's something you can do. Why don't we go to our...
Let me take a couple minutes and talk about some planning, more planning for the Sanders slide. First, for those on the audience, this slide on page 12 and 13, this is on the Sanders, and we just did a slide on the Von Hollen bill on slide 13. I added to the slide deck last night, so we would have these to talk about, realizing that we really needed to refocus our discussion today about what's really going on most currently right now. Now, nobody can predict whether or not the Sanders bill is going to get enacted. It, as a colleague, a very bright, well-known colleague in the estate planning world, made a comment in a conversation that Jonathan and I were having with her the other day. I don't want to mention her name in light of the comment, that the Von Hollen bill, which we're going to talk about in a couple of minutes, actually makes the Sanders bill look conservative. That's how extreme those provisions are. A webinar I listened to yesterday with a number of bright colleagues speaking, I don't have the exact language in front of me, but to my recollection, they use language to the effect of that they thought it was highly unlikely that either the Sanders or the Von Hollen bill will be enacted exactly as they are. That being said, I think it would be a terrible mistake for clients not to act and act decisively as quickly as possible, because incredible planning opportunities could be lost. There's absolutely no way to predict what could get enacted. And gee, we could get a double whammy of the Sanders bill that we just talked about, and I want to give you a few more planning ideas on, and the Von Hollen bill both getting enacted, which would absolutely decimate planning as we now know it. And frankly, either of these bills will completely change, drastically change planning as we now know it. Let me make a couple of very important points about the Sanders bill. One, Jonathan made, but I just think it's so vital, I want to reemphasize it. I've heard and seen articles and people talk how the exemption is not going to be changed until January 1, 2022. That is a dangerous, dangerous thing to rely on, because as Jonathan pointed out, the changes to the grantor trust rules, which are fundamental to planning as we know it, are the effective date of the Sanders Act. So nobody should wait till the end of December to make gifts. Now, if you can make gifts, it's certainly worth doing it, even if you can't make them to a grandfathered grantor trust. But right now, if you get clients to move, the act has not been passed, you can still get grandfathered grantor trust set up. I think any client of even moderate means, and I'm going to leave that as a vague term because it just depends, and I'm going to give you a few comments on that in a minute, but even clients of moderate means, it behooves them to set up grantor trust just to have it. Creating a basic ILIT, irrevocable life insurance trust, and putting some money in it just to have that type of trust out there makes a world of sense for even a moderate client. I think a client of somewhat greater means, and I wouldn't even go very wealthy, but of somewhat greater means, should look at creating a robust trust that is in a trust-friendly jurisdiction, Alaska, Nevada, South Dakota, Delaware, like a SLAT, Spousal Lifetime Access Trust, that's a grantor trust with whatever bells and whistles you want. One of the provisions that we're going to talk about, and I think it was the von Hollen, not the Pasquale, there was another proposal. I haven't been able to read it yet. I don't even know if it's been in act form yet, that talk about the idea that if you decant a trust, unless the IRS certifies that there's no tax, I forgot the exact language, benefits to it or consequences or avoidance to it, that if you decant a trust, you lose grandfathering. So you really want to get everything done you possibly can before enactment. Now, another very important point that has been missed in a lot of the discussions, and I'll tell you, Jonathan and I were speaking with a CPA that we wrote an article about the Sanders bill and planning for it with. And somewhere when I was talking to her during the course of writing the article, the light bulb went off and she went, oh my, she realized that even her insurance trust could be significantly adversely impacted by the Sanders Act. And she never viewed herself wealthy as her clients. She's a working mom with a bunch of young kids and has a lot of term insurance to protect her kids, as makes perfect sense. And it dawned on her that the grantor trust rules under the Sanders Act will taint that insurance to some degree being included in her estate. Now,
Marty,
yeah.
let me mention, someone said for grandfather trust, what about additions? Well, no, that's
what I was just coming to now.
Yeah, if you make an addition, you're going to be cooked with respect to the addition. It would probably be a proportionate test. So if the trust is worth, and I'm going to make up these numbers, $500,000, and you pay a $50,000 premium, well, now 1/11 is going to be tainted and cause estate tax inclusion. So that's very important to keep in mind. What we don't know, and I'm having discussions with colleagues, is whether you make an installment sale to a grantor trust or you swap an asset for what's into the grantor trust. Does that also cause a taint for under the Van Hollen bill, which we'll come to? It won't under Sanders. It's quite clear if you have a pre-existing grantor trust, you can do normal non-gift transactions with that trust and you won't lose the grandfathering from estate tax inclusion. And again, I think one of the most important things you can do for yourself, one of the most important things you can do for your clients is to convince them to do a grantor trust now. Not when you think it's going to be enacted, but right now. Very, very important. One other thing I want to mention, Marty talked about doing SLATs, which are extremely popular, Spousal Lifetime Access Trust. Those are great. Remember, normally that's going to be a grantor trust, and you structure it so it's not going to be in your spouse's estate and it's not going to be in your estate. And again, if you do it before the effective date, you're going to be okay because it won't cause estate tax inclusion. But there is going to be a problem because a lot of people who do SLATs wind up getting divorced. When you create a trust for your spouse, even if it doesn't qualify for the marital deduction, it's going to be a grantor trust with respect to the grantor. And even if you get divorced, it continues for a new trust to be a grantor trust with respect to the grantor. So Bob creates one for Sally, or Sally creates one for Bob, and they get divorced. Well, for the trust that Bob created for Sally, he's going to continue to be the grantor and have to pay income tax. And as you know, most people don't feel very warm towards their spouse. Two things to do. One, when you draft a SLAT, you need to either put in that if we get divorced or separated, my spouse is no longer an eligible beneficiary of the trust, and you'll put in strong no-no language to prevent it from being a grantor trust, or you have to put in that distributions to the spouse can only be made with the consent of an adverse party, which will mean that sections 676 and 677, which causes a trust for a spouse to be a grantor trust with respect to the grantor, won't apply, assuming you don't have another provision in there which would cause grantor trust status. For example, a swap power. So if you do a trust and you say, well, I've done this, so it's not a grantor trust, I've provided that the spouse is out, or she or he can only get distributions with the consent of an adverse party, that's not enough, because you may have other provisions in there that continue it to be a grantor trust.
Let me just make 2 points, and then we're going to go a couple of quick points in terms of planning. So to highlight what I was finishing and what Jonathan just said, this is not only going to affect uber wealthy clients. A moderate wealth client that has a $5 million term insurance policy in case she dies and has a bunch of kids to take care of, that could be absolutely decimated as a plan. Let me take Jonathan's example a little further. So say you paid for 10 years, $10,000 a year, not even a huge amount. You got plenty of gift exemption, even under Sanders, to make the gifts to the trust. But if you pay $10,000 for 10 years, that's 100 grand you put in the trust. You make another 10 payments following the Sanders Act of $10,000 a year to pay your premium, and then you die. It could be that half of that insurance proceeds is now taxable in her estate, decimating the estate plan. So we need to reach out not just to uber wealthy clients, but to much more moderate wealth clients. And the solution for this, I think, is kind of simple. And I'm actually having my wife do it. I just wrote a note while we were talking to make sure I don't forget. She's going to make a gift in the next week or so to her insurance trust of maybe 10, 15 years of premiums. So we don't have to deal with this for a long time. We're kicking the can down the road in terms of additions in case the Sanders Act gets enacted. So that's the kind of planning that you need to reach out to all your clients to do. Another very important point. Think of a physician client. Every physician client is terrified, worried, as frankly all of us should be, of malpractice because of the litigious nature of society. And that's not changing whatever happens in Washington. Well, think of what a $1 million gift exemption does to a physician trying to do asset protection planning. Do it now. Set up a SLAT, adapt any kind of trust where you preserve as much access as the client needs, wants, and is comfortable taking whatever risk that access creates. Create a trust now and make those transfers now. You know, with all the limitations in the Sanders Act Jonathan went through on discounts, grats, and everything else, it's going to be very, very difficult to leverage gift transfers for asset protection. And right now, a physician or anyone else doing asset protection has the perfect cover. If you've just listened to this presentation, there's enough worry about, oh my, what the estate tax could become, and we haven't even finished with the Von Hallen, which we're going to jump into, that anybody making a transfer could easily say, I'm doing this for asset protection, not for asset protection. I'm doing this for estate tax. So let's go on and talk about the Von Hallen bill and what that does. Jonathan, you want to give an overview of that?
Thanks, Marty. The Von Hallen bill, I mean, the tax-free step-up in basis is probably the major factor in all of estate planning. And you get that step up in basis even if you don't pay estate tax because your estate is below the exemption or because you leave it to your surviving spouse. I knew a man out west who had a $2 billion estate. He died. It all passed to his wife under the merit election. The basis in that stock essentially was zero. It was worth $2 million when he died. Her basis is $2 million. It is an extraordinary giveaway under the system. And there have been many attempts to try to end it. In fact, my first book was under the carryover basis rules under the 1976 Tax Reform Act, but Congress retroactively repealed that in 1980. But carryover basis, no step up, came back in 2010, but it was only for 1 year. And there have been a number of proposals for carryover basis, but Chris Van Hollen, the senator from Maryland, has gone even further. He said we will have gain recognition at death, very much like the Canadian system, which has been in effect since 1972. Gain would be recognized when appreciated assets are transferred by gift, in trust, with an exception of a type 4 grantor trust, or at death. So if I give appreciated assets to my son, if this bill becomes law, not only may I be subject to gift tax, or if I transfer it to him when I die, subject to estate tax, but in addition, there will be gain recognition by me. Very, very important. Now, there's an exception for transfers to spouses, but there's no Q dot here. It's only if this recipient spouse is a U.S. citizen or a long-term U.S. resident, 8 out of the last 15 years. They're very, very important. Appreciated assets in a non-grantor trust, when they are distributed out, also would be a gain recognition event. So if you have a pre-existing trust and you say, hey, I'm golden, I've done all my planning, got lots of appreciation, the investments have been just fantastic, and I want to give something to my son so he can buy a home, or my daughter so she can just do a business, or they're going to be distributed out when I die, guess what? You're going to have gain recognition, a very, very, very far-reaching bill. And if they stay in the trust, even if it's grandfathered, every 21 years, there would be gain recognitions for the assets in a non-grantor trust. Now, Representative Pascrell, who's from New Jersey, has put in a similar bill to the Van Hollen bill, and he says we'll only tax the trust on their appreciation every 30 years. But this think
of what that does, folks, to the whole fundamental basis of estate planning. Forever, we've been focusing on, for a very long time, multi-generational planning, right? The whole benefit of GST planning and long-term trust is to put assets in a trust and let them compound forever. Remember, compounding is the 8th wonder of the world. Well, every 21 or 30 years, if that asset is subject, that trust asset is subject to tax, Jonathan, after 2, 3, 4 generations, what is that going to do? What's going to be left?
Well, it's going to be very bad. I mean, we will come up with some techniques to try to do it, but I understand in England, where they have a similar rule, every 21 years, a trust must recognize its inherent gain, the use of trust has been vastly reduced. So that's something that you've got to take into account in structuring. Now, there is an exception for transfers to grantor trusts, but only if the trust is structured to be in the grantor's estate. Again, they are grandfathering trusts, but the grandfathering only applies to trusts created before this year, because the Van Hollen bill is effective 1/1/2021, this year. And let me just give you an example about how scary this is. You went to a client, you said, look, they may well decrease the amount of gift tax exemption. I recommend you put that 11.7 million or whatever you've got left in a trust for the benefit of your kids. And we want it to be a grantor trust. Of course, we don't want it in your state, or we don't want it to be a grantor trust, whatever your choice is. So the client said, yeah. And then you discussed with the client what's going to be. He said, well, look, I have this investment. It's gone up a lot. It's called Bitcoin. And it's really appreciated, and I think it's going to appreciate a lot more. So they take appreciated assets and they put this in this trust, apply the $11.7 million exemption, and you think, I'm golden. I beat Bernie's effective date of 1/1/2002, although, as Marty says, that's not guaranteed, but it's highly likely it wouldn't be retroactive to the beginning of this year. But Van Hollen would be. So now the client has taken 11.7 million of appreciated assets, put them into a trust, which may be a grantor trust or not, but because it's not going to be in the grantor's estate when she dies, you now have gain recognition on those assets back to the beginning of this year. That's very scary. And one of the things that you need to do when you talk to clients is to warn them that it may well be that making any transfer to any human being other than your spouse, if she's a U.S. citizen or a long-term resident, or to a trust, even if it's a grantor trust, if it's not structured to be in the grantor's estate, you're going to have gain recognition. Some of the things we don't know is, suppose you put
Jonathan?
Yeah,
I apologize to you and Jonathan. I have an emergency I have to deal with. I'm going to let you finish the last 12 minutes of the webinar without me. And okay. I think what we should do, and I'll do it to also apologize, I'm going to get my son, Jonathan, the article we did for Lissy on planning for this, that he can send out to everybody that attended as well. I apologize, everybody. I have a personal emergency I'm going to have to tend to.
Marty, can you transfer control to me or to Jonathan?
I can stop screen share. I'm going to stop share.
Let me see if...
I apologize, everyone.
Okay. Everybody, if I can do it, I'm going to talk a little bit more about the Von Hollen bill, but let me see if I can bring up my own. Okay, you cannot start screen where another person is sharing. I thought Marty said he wasn't going to share, but
here, I got it, Jonathan. Just
okay, well, great. Let's, if we can bring back to where we had that Van Hollen stuff, because there are things about it we just don't know. Now, Representative Pascal, as I mentioned, from New Jersey, has put in a similar bill, a little bit more generous on a 30-year gain recognition for assets in a non-grantor trust. But again, the scary thing is if you go ahead and you transfer assets under the Van Hollen bill, now under the, by the way, the Pascal bill, it would be effective January 1, 2022. Van Hollen, it would be January 1, 2021. I find it hard to believe that's going to happen, but here's the most important thing for you to think about, in my judgment anyway. Warn your clients. I met with a gentleman the other day and he said, there's not a prayer that either the Sanders bill or the Van Hollen bill is going to pass. It can't be. Now, he is a card-carrying, red-blooded Republican who dream. By the way, that reminds me of 1976, where people thought that maybe we wouldn't get the Tax Reform Act of 1976, which had enormous changes, including generation skipping transfer taxation, something that people thought was an anathema. They could never adopt it. Well, it happened. So don't think that these things can't happen. But now here's a question. I have a pre-existing grantor trust that's out of my estate, and it's not caused by Van Hollen. It's a grantor trust. It's not in my estate. Can I do an installment sale today or a swap for other assets and avoid gain recognition? There is a serious dispute as to what the bill says on that. Mitch Gans and I say, no, it does not appear to be covered. That's one of the reasons why you want to have a pre-existing grantor trust. But we just don't know, because there are a couple of very, very, very bright practitioners who said, Jonathan and Mitchell, you're wrong. We think there will be gain recognition. One of the things we think is that the Congress will make it clear. But I'm hoping that grandfathered trusts are okay. And if you do a transfer for full value, you won't have gain recognition. But again, there are some very bright practitioners who think otherwise. So that's really a scary thing. But again,
and when you want me to move the slide, just say next slide.
Okay, but keep in mind the following. If you have a new grantor trust that's not in the estate, the typical kind of thing we do, you create a slat for your spouse. It's going to be a grantor trust, no doubt. In fact, you say, well, that's good. It's a grantor trust. I get to pay the taxes on it. Well, remember, two things happen. Under Bernie's bill, if it's a new grantor trust created after the date the bill is passed, not January 1, 2022, but the date the bill is passed, you're going to have that trust includable in the grantor's estate. One of the reasons why you need to act now. But if you're going to urge a client to do that, I would strongly recommend you say, fund it with cash. So raise cash, make that transfer, even with a retroactive Van Hollen date, you're okay. And the question is, if later you say, well, I want to substitute those assets, which I think are going to appreciate in value, am I going to have gain recognition? Well, clearly, let's say, again, you think Bitcoin is the way to go. Well, you can have that trust take its cash and buy Bitcoin. I don't think there's any gain recognition then. And why should it be different if I have the Bitcoin and I sell it to the trust? Non-taxable because it's a grantor trust. It would be non-taxable with cash anyway. So I think that Mitchell and I are probably right, but it's not sure. And your job has to be to warn your clients. So again, gentleman I met the other day said, Jonathan, there's not a snowball's chance in Haiti that that's going to be retroactive, but we'll see. Jonathan, let's go to our next slide, please. Okay. Yeah, protection against retroactive changes. What can we do? And there are a couple of things that can be done. One is to use the exemption now. And as Marty said, you want to get asset protection. And the reason you're doing this is not for asset protection per se, but going ahead and trying to get good estate planning. And I'm not going to tell you a story, but I've had the bankruptcy judges say, if you could prove to me you did this for estate tax planning purposes, we're not going to put it in your bankrupt estate. There's even this provision 548E of the bankruptcy code, which says if you create a self-settled trust and you did it to hinder, delay, or defraud creditors, it's going to be back in your bankrupt estate if you go bankrupt within 10 years. I don't think you have to worry. You're going to be able to establish you were doing this for estate planning reasons and you're okay. Now, by the way, Elizabeth Warren has proposed a wealth tax, and Senator Wyden, who's the Oregon senator who's chair of the Senate Finance Committee, he's a big deal in taxes. Elizabeth wants an annual wealth tax. If you have more than $50 million, which both Jonathan and Marty have much more than that, so they have to worry about this. Fortunately, I don't have to worry about it. Wyden would say that we're going to have a mark-to-market rule for appreciation. He probably will limit it to marketable securities only, and we don't know if you put it into a holding company, how it would work, but it just would be almost impossible to administer a system where you have an annual imposition of appreciation. Although think in mind, real estate taxes presumably are determined every year on their annual valuation. So there is some precedent on that. But all these changes, you just can't ignore them. They could happen. Jonathan, let's go to our next slide if we could, please. Let's go ahead and do even more. You know, this Marty we put in a lot of things to do here, but let me mention two things specifically on slide 17. One, I think you want to build in every transfer you make the ability for a disclaimer to occur under section 2518 so the assets can revert back to the grantor. 2518 says, as a general rule, if you offer something to someone and that someone disclaims it as described in 2518 within 9 months, then you have not made a gift by the disclaimer. And if the assets revert back to the donor is not treated as though she ever made the transfer. We have some language in this slide, which I've actually used for myself as well as for clients. So that's one of the things you could do. Think about in every transfer you make it in trust, but provide either that the trustee can disclaim or the principal beneficiary can disclaim. There will be an article out in the May issue of Estate Planning by Vanessa Kanega and Beth Bonham that will explain how it works. There will be sample language there as well. If you subscribe to Wealth Transfer Planning, we already have it in there, but that's something to do. What else can you do? Well, if you're married and you love your spouse, you could create a Q-tipable trust for your spouse, if but only if the spouse is a U.S. citizen. There's nothing like a Q-dot for lifetime transfers. Your spouse has to be a U.S. citizen, long-term residency, which I mentioned before, under the Van Hollen bill and the Sanders bill. Won't help you. You don't have to decide how much you want to qualify for the marital deduction until October of 2022. So you have lots of time to say, do we want to have the exemption used so we won't elect Q-tip treatment, or we don't want to use it because of changes or for any other reason. So we do make the Q-tip election. No gift tax will be due. Trustee can give the property to the beneficiary spouse, who can give it back to the donor grantor spouse if that's what you want. By the way, some people have said, well, how about a Clayton Q-tip? This is one where, to the extent you don't actually make the Q-tip election, it falls into a family type trust. That's in the regulations for estate tax purposes with respect to Q-tips. You can't do it for inter vivos Q-tips. Don't even think about it. Don't even try. It will ruin your day. I am absolutely sure. Make sure that you do not try that. But one of the things you can do is you say, well, I kind of like the fact that we can go from a you know, from a Q-tip to a family trust. Well, here's one of the ways you can do it. You could provide that the surviving spouse could disclaim it. You have it go into a Q-tipable trust. You elect for it to qualify for the marital deduction. And then the spouse says, I disclaim. And the disclaimer puts it into a marital trust. You can go ahead and do that. Of course, the problem is one of timing. The disclaimer has to be done within 9 months of the time the trust was created. Now, that will take us fully into next year, but you're going to have to be very, very cautious in setting it up and having the provisions in there. Very important. Jonathan, let's go to our next slide, please. We suggest that you consider having your clients sign a solvency affidavit. It's going to protect them to show that they weren't trying to bilk anybody, and it protects you as well. It may also be appropriate if the clients want to give away, you know, a lot, to make sure they can afford to do it. Although, as we will discuss in just a couple of minutes, Jonathan, how much time do we have left? I mean, we only have about 5 minutes. Let's go to our next slide, Jonathan. Yeah, they can make these laws retroactive. Let's go. Keep going. Here's the sample formula. We're going to send you these. This is the one where you can divide the transfer so you're exactly using the gift tax exemption, and any excess goes to your spouse or to a marital type trust if your spouse is a U.S. citizen. If she's not a U.S. citizen, it won't do you any good. Let's go further, Jonathan. Even more. Yeah, I mean, a lot of changes, income taxes, especially again with people who have, say, $1 million of income, are going to pay a lot more income tax, not just because the marginal rate will be increased to 39.6, but because Social Security taxes are going to come back in after 400,000 of income with an extra 12.4%, keeping in mind that that Social Security tax is not income tax deductible. The good news is, for those of us who live in the metropolitan area or in California, is that the Democratic House members from California and New York have basically said, President Biden, you want something like this to go through with infrastructure? We want that SALT deduction back in full. Boy, that would be great for those of us who live in the land of taxes. Let's go to another one, Jonathan. Capital gains, you know, Biden has proposed, and this is the Warren Buffett rule. He says, why should I pay a 20% tax when my secretary is paying basically a 40% tax? It's because he has long-term capital gain. But they're proposing if your income is $1 million or more, all long-term capital gain would be taxed basically as ordinary income as short-term gain. One factor to consider, if you think these changes are going to go through, you should cull your gains now at that 20% rate, plus you may pay a 3.8% net investment income tax. So take the gains now rather than wait until it's going to be 39.6 plus the net investment income tax. You might say, yeah, but I'm not planning to sell this for 5 years. You think about how much that property left over after the taxes has to earn in order to catch back up when you're paying an effective 44% tax, plus maybe state and local taxes if you live in one of the high tax jurisdictions like New York City.
All right, Jonathan, we're actually at time, so I thank you for picking up the slack here, and I hope everything's okay. I'm just going to read the last code, but before I do, I'd like to thank our speakers, Martin, Jonathan. If anyone has any specific questions, new business opportunities, or any other issues they'd like to discuss, please feel free to reach out directly to the speakers or myself where appropriate. And I'll be sure to include their contact information in the follow-up email of this program. A bunch of people asked me about the slides. The slides were sent out in a reminder email. They will be sent out tomorrow again in the follow-up email of this program, so everybody will have access to the slides and any other handouts that the speakers subsequently hand me. Next, if you are a licensed New York or New Jersey attorney or CPA and took this course for credit, the final code is A30. Again, A as in apple, 30. One more time, A30. Tomorrow morning, you'll be receiving a follow-up email to this program with a link to fill out the evaluation form and to input the codes in order to receive credit. Again, the evaluations form will be sent out first thing tomorrow morning. Second, my next program will be on April 29th. It's entitled COVID-19 New York Tax Hot Topics, featuring Timothy Newton, tax residency practice leader at Hodgson Russ. With increasing taxes and Tim's background handling hundreds of audits, litigated cases, and appeals, this is sure to be an informative session. You'll receive an invitation to this webinar and all my upcoming sessions in the near term, and I hope you can attend. And with that, this concludes today's session. Please stay safe and healthy. Have a wonderful day, everybody.
Someone wants the code again, Jonathan.
The first one is A23. The second one is A30. Okay, have a good day, everyone.
Thank you all for listening in.
Thank you.